Mr. J Ramaswamy is Director of Finance at HPCL. He joins us on the phone line from Delhi. Mr. Ramaswamy, good morning. Many thanks for joining in. When we decided to, request you for a quick interaction on Monday morning, we would have thought that the OPEC would have given meaningful commitments which would have led to some meaningful increase in crude production and thereby some fall in crude. Hasn't quite played out that way. What have you made of all of this, and what is the impact that you foresee on the Indian refiners or the Indian OMCs?
Good morning. I'm joining from Bombay. Basically, we need to understand the meeting outcome of a recent OPEC from the position of November 2016 meeting, where basically OPEC and non-OPEC countries together agreed for a reduction of 1.8 million barrels per day earlier in November 2016, which due to sudden non-compliance has gone up to as high as 152% for OPEC and about 152% for OPEC countries and non-OPEC countries as well. Now that commitment to comply with that 1 million barrels cut is now trying to put sudden additional 1 million barrels per day of oil into the system. And that's how, basically, if you look at it, it's nothing but a reiteration of November 2016 commitments which has been given to stick to the 1.8 million barrels per day type of reduction.
Right.
Which has gone beyond that, and they are restoring back to 1.8 million barrels. And this is actually putting...
No, Mr. Ramaswamy. Mr. Ramaswamy, allow me to come in. So the question really from anybody who's listening into this conversation right now would be, where does HPCL, with its estimates of where crude will be given the OPEC statement, believe the gross marketing margins could be as well, because they've been on a bit of a declining trend due to various factors, I admit, but they've been on a bit of a declining trend. Based on your expectations of crude, where do you expect GMMs to settle down to?
You're talking about gross margins for the refineries, right?
Yes, please.
Okay. Now the gross refining margins for...
No, I'm talking about the gross marketing margin, sir.
No, gross marketing margins is a complaint of end finished product prices, besides the crude product prices. Okay, yeah, the end product prices are supposed to be reflected of the crude prices. Therefore, we don't expect a significant variation in the current marketing margin level, which we are actually getting to.
So the trend which has been on a bit of a decline, with post the OPEC meet, I'm guessing you're saying it doesn't change anything materially.
As of now, we need to wait and watch, because this gradual increase in the production also will be gradual over a period of next 2 to 3 months. Plus, we also need to see how the other events like, Iran are getting settled and Venezuelan crisis, as rightly mentioned, how they are going to actually play out in the market, we need to really see. But as far as we are concerned at this point of time, when we maintain a long-range bullish trend only in the range of $75 to $80 for crude oil, at the same time, we don't expect a great change in the marketing margin unless the crude prices very significantly fall short, which the geopolitical as well as other events that are going to unfold in the near time will tell us.
Mr. Ramaswamy, one last question, and that's off what OPEC did, but Singapore GRMs too, as I see, have contracted and have been on a falling trend. Could you tell us your thoughts on what the trend is looking like here?
Basically, the Singapore GRMs have cooled off due to gasoline cracks and naphtha cracks, which are a bit depressed. In fact, naphtha cracks are in the range of 2.5 to negative of 1.5 to $2.5, and gasoline cracks from a high of double digit has come to $8 to $9 per barrel. This is due to gasoline and naphtha cracks being weak, and that's basically attributed to higher refinery runs and additional supply coming from China, which is putting pressure on the cracks. So going forward, I think for HPCL refineries, of course, the GRM is, though it is, directionally related, is not absolutely related to Singapore GRMs, because Singapore GRMs are basically dependent upon the daily crude runs, no inventory holding, no inventory gain losses scenario. So these things put together will play out on the Indian gross margin of the refiners. And therefore, as far as HPCL is concerned, we're confident of returning around $6 to $6.5 per barrel.
Okay, we'll leave it at that, Mr. Ramaswamy. Thank you so much for taking the time out and speaking with us this morning.
Thank you. Thank you.